Okay, so let's talk about the stock market. Every single day, it is this massive, chaotic storm of flashing numbers. But for the people who trade inside that storm, intraday traders, it really all boils down to a single fundamental choice. Do you ride the wave or do you bet on it crashing?
Right, so that's the big question, isn't it? In all that chaos, how do you actually find an opportunity? Well, for a day trader, the answer isn't just about what stock to pick. It's about which side you're on, philosophically speaking. And that choice, it defines every single move you're going to make.
And just so we're all on the same page here, when we say intraday trading, we're talking about a very specific game. You're in and you're out, all within the same day. No holding positions overnight. The clock is always ticking, and you either win or lose before that final bell rings. So, this daily puzzle, how do traders actually tackle it? Well, it turns out pretty much every strategy you'll ever hear about falls into one of two camps, two totally opposite ways of thinking.
Yeah, this is really the fork in the road. Do you believe that a trend that's already moving has the best chance of continuing to move? If so, you're a breakout trader. Or do you think every trend eventually runs out of steam and has to turn around? That's reversal trading. It's really a clash of philosophies. Ride the wave or predict when it's about to crash.
All right, let's talk about that first approach, the breakout. Think of these traders as momentum chasers. Their whole game is about spotting a stock that's building up pressure, like a coiled spring, and then jumping in right as it explodes. You know, the logic here is super straightforward. It's basically physics. An object in motion tends to stay in motion. So a breakout trader is looking for that precise moment when a stock smashes through a key price level, a ceiling or a floor, and then they try to ride that powerful move that follows.
Okay, so a classic strategy here is something called the opening range breakout, or ORB for short. This thing's been around for decades, and it's built specifically to take advantage of all that crazy volatility you see in the first few minutes of the trading day. And here's how it works. It's a pretty clear four-step plan. You're not just guessing here. First, you figure out the market's main direction for the day. Then, you mark out your territory, the highest and lowest price in, say, the first 15 or 30 minutes. The signal to act is a strong price move outside that range, and your proof? A big spike in trading volume. That tells you other big players are jumping in too.
And boom, here's what that looks like on a chart. See that box? That's the opening range. Then look at that massive red candle just punching right through the bottom. For a breakout trader, that is a flashing red light signaling a potential short trade, basically a bet that the price is going to keep dropping.
So that's one way. But there's another method, which the Dan YouTube channel points out. Instead of just looking at the morning's action, you use something called pivot points. These are key price levels calculated from the previous day's data. If the price makes a strong move above that first resistance level, what they call R1, well, that's your green light to get in. Okay, so let's put it all together. If breakout trading is all about finding a party that's already rocking and jumping right in, then reversal trading is about standing outside, watching the party, and predicting the exact moment the music's going to die and everyone's going to run for the door. It's a totally different mindset.
All right, so we've covered the partygoers. Now let's talk about the traders betting the party's about to end. This is the reversal approach. It's for the folks who live by the motto, what goes up must come down. And this quote from trader Adib Noorani is just a perfect analogy. He says VWAP is a magnet. This really gets to the heart of reversal trading, this idea called mean reversion. The theory is that price is like a rubber band. You can stretch it really far, but it always wants to snap back to its average. And in this case, that average is the VWAP, the volume-weighted average price. Okay, so a really popular reversal strategy mixes that VWAP magnet with another tool called Bollinger Bands. Think of the bands as showing you when a price has stretched way too far, like that rubber band is about to break. But here's the crucial part. The signal to trade isn't when the price hits the band. No, the signal is when it starts to snap back inside the band. That's when you jump in and your target is that VWAP magnet we just talked about.
Of course, you never want to rely on just one signal, right? As the ICFM Institute points out, reversal traders are like detectives, looking for clues. They're looking for a bunch of things to line up. Maybe the RSI indicator says the stock is overbought, the buying has just gotten out of hand. Or maybe they spot certain candlestick patterns that suggest the buyers are just getting tired. It's all about building a solid case for that turn.
So there you have it. Two totally opposite ways of looking at the market, chasing momentum versus betting on exhaustion. But what's really interesting is that no matter which camp a trader is in, they're all drawing from the same basic toolkit to make their decisions. And this table really lays it all out. You can see how these tools are used differently. Pivot points, that's pure breakout territory. VWAP and Bollinger Bands, that's the reversal trader's playground. But look at volume. Volume is the universal translator. For both strategies, a big spike in volume is the confirmation that, yep, this move is for real. Okay, so we've talked a lot about charts and indicators. But here's the thing. Every single source we looked at said that none of that matters without discipline. The specific setup you use can change, but your rules, those have to be rock solid. And rule number 1 is just about survival. The ICFM Institute makes this super clear. You should never, ever risk more than 1 to 2% of your entire trading account on a single trade. That's not a guideline. It's a lifeline. It's what keeps you in the game to trade another day. And then you've got the 3 cardinal sins of trading. They all boil down to letting your emotions take over. Overtrading, making a dumb trade just because you're bored. Ignoring your stop loss, hoping a bad trade will magically turn around. And just a total lack of discipline, throwing your whole strategy out the window on a whim. This is what destroys trading accounts. And really, this quote just says it all. It all comes back to this: consistency, managing your risk, and keeping your emotions in check. The charts, the strategies, they're just the tools. But this is the foundation that everything else is built on. So, as we wrap this up, it's pretty clear, right? While it's fun to look at all the different ways to get into a trade, the real strategy isn't just a pattern on a chart. It's the whole system, the rules, the risk management, the discipline that you bring to the table every single day. So the question to leave you with isn't just what strategy will you use, it's will you have the discipline to actually stick to it?